Well, welcome back to another segment of Arizona Mortgage News Insider Update. We are here with our resident expert, Mike Goblet of United Mortgage and Financial Group. Good morning, Mike.
Good morning, Matt. How are you?
Quite well.
Good.
So I understand we got another acronym we're going to cover, DTI.
Yeah, it's a very important one that again, it plays a large role and people need to understand it and all the variations of it. So DTI stands for debt to income ratios, okay? And it has to do with how much money you make versus what your bills are. Pre-mortgage meltdown, people used to be able to do things like just stated income. Just tell me how much you make. If you had great credit or stated assets, I'll do the loan just based upon your assets. That stuff went all the way with the Dodd-Frank bill and with the mortgage meltdown and lenders looking to protect themselves. Today, mortgages are much more driven by income than by assets. Now, I don't want to say assets aren't important, but they do not outweigh your monthly income. I have a tongue-in-cheek statement I make, but it's only tongue-in-cheek because it's also true. I say you could have $5 million sitting in a checking account and the bank would tell you, that's really great, nicely done. How much do you make per month?
They want that reoccurring monthly revenue.
Yeah, that becomes the driving force in their belief and understanding of what will make the loan successful. Be it accurate or not, it is the way lending is today.
Well, if you had $5 million in the bank account, you could lower your PMI and not have mortgage insurance.
I think the bank, in terms of the risk, would rather say, then why don't you buy the house outright rather than borrow money? But anyway, yeah. I don't want you to do that. I'm willing to help you borrow money at such low rates today. It makes it well worth your while.
And are there some magic ratios with the DTI that we need to pay attention to?
There are two ratios. It breaks into two components, what they call the front end ratio and then the back end ratio. The front end ratio represents the mortgage payment itself versus your income. Now, the mortgage payment yourself means principal and interest, your monthly taxes and insurance, whether they're being escrowed or not, and any HOA fee, even though it might be paid quarterly or however, they figure it into your total monthly payment. Break it down on that, okay? So the number that most banks look for is a maximum of 36%, but you can get exceptions up to 38% of your income. So for example, if you made $3,000 per month, you would be capped at a total mortgage of $1,140 or 38% of $3,000.
Makes sense.
The back end ratio gets very important as well. And what that looks at is your total indebtedness versus your income. That really shows off of your credit report and or any other contractual debt you may have, even if it doesn't show on your credit report. Now, that number is usually considered to be 43%, but we can see exceptions based upon a number of other factors up to 50% and can get an automated approval. So there's a wide range in there of your total indebtedness. By the way, it also isn't based upon how much you actually pay, but what your minimum payments are on those debts on a monthly basis.
Gotcha.
Some of the residual, like I said, the reason it can run from 43 to 50, 50% of $3,000 of residual income is not the same as 50% of $10,000 a month of residual income. So sometimes you may only get the exception to 45% or maybe held at the 43, depending upon what type of other variables are part of it.
Very good.
Well, it's also now, how do you figure your income? How do you calculate it? Well, if you're a W-2 employee, it makes it very simple, and if that's your only source of income. But if you receive other income from investments, rental income, or if you're a self-employed borrower, now we need to get to what your actual after-tax income is, because that's the number they'll use. So if you have a great accountant and you're self-employed and they get you every tax advantage you can, it can possibly hurt you in spite of how much money you actually make, because we're going to end up with net income.
Aha. You're not showing the full story, and that come to bite you.
It can, but and you just, you know, on an everyday basis, when you're not getting a mortgage, you want to take every tax benefit you can. But when it comes to mortgage lending today is I mean, there are some things you can back in, and that's why we look to evaluate, but it's mostly based upon after your accountant is done with your income that they utilize. So.
Very good. Well, for those that have questions about any of the acronyms, DTI, PMI, what was the other one we talked about?
LTV.
LTV, loan to value. What's the best way to get in touch with you, Mike?
Well, you can call me here at the office at United Mortgage Financial Group. The number is 480-503-3533. Or you can call me direct on my cell phone at 480-220-2329, or email me at mike.goblet at our company initials, umfginc.com.
All right. Well, thanks again for enlightening us, Mike. Any acronyms on the future to talk about?
Actually, I don't have that off the top of my head where the next one will be.
All right. Well, we'll look forward to the next segment.
Okay, Matt. You have a good day.
You too, Mike.